Right now, let's talk the macroeconomic themes. Dan Genter is joining us, CEO and CIO at RNC Genter Capital Management. So Dan, let's start off with some big picture stuff, because right now a lot of people are talking about policy, trying to figure out what the new administration is going to bring to the table here. And one of the charts that you've got looks at what we're spending right now and the potential for closing the gap via taxes. And this is one of those things where so far the narrative has been very positive about the stimulus and what that's going to mean, but there's still a possibility that maybe we'll be seeing less market-friendly activity going forward. So does this chart have to close via taxes?
Well, I think, Oliver, it's going to have to close over time. I mean, we're operating basically at a deficit now that equals 1 year GDP. So it's going to have to come down. I mean, we've expanded from where we were at 14 trillion now to 21. So it's certainly something's going to have to be done about it. And obviously the spending will go down once we go into post-COVID, but you're just going to have to make up some of that deficit that we have and the additional debt that's being raised and how you're going to have to cover it. So there's really not much choice at this point that those lines are going to have to converge. I mean, the spending is, and the extraordinary spending that we're seeing now is going to come down. You're going to have some increase in revenue. You know, the new administration has made it very clear that they're going to raise taxes. I mean, frankly, the easiest thing for them to do right now, because it doesn't require drafting all new legislation, is just to repeal all of the Trump tax cuts. But unfortunately, even though many people would say, well, that's not so bad because I get my mortgage deductions back, I get my state income tax back for the states that pay that. You know, the reality is that we probably won't get the deductions back. We'll just get the higher rate and immediately go from 37% back to 39.6%, you know, along with, you know, the other rollbacks that we had for corporations with those taxes going up. So I don't think it's going to be a happy day and for individual taxpayers at the higher level, certainly, and it's not going to be a good day for corporations. And we're just very likely to see it, and you know, that'll be the strategy in the format.
And to the point on this subject, as Treasury Secretary expected to be, at least Janet Yellen designate right now, it kind of left that door open a little bit in terms of receiving questions from senators about taxes, not saying they're going to hike across certain income brackets, but that they might, namely $400,000 earners or more. So right now it's definitely a possibility. Probability, I guess, would depend on how one wants to read between the lines. But we do know that the next phase is going to be something very different from the one we're going through right now. And I think that's important, right? Because even if there is spending that continues on from what we've spent already, it might come with some catches this time.
Well, absolutely. I think it's going to be more targeted. We're going to have political overtones, obviously, where there were disagreements in the past between the parties and how that money was being spent. So you're going to have some money that's going to go into different directions. The cost of borrowing additional money is going to go up. We're seeing interest rates go up already, and we've gone up from literally about a 0.6 where we were in the 10-year to, you know, now we're, you know, well into over 1 territory. And you've got a 2-year, 10-year spread that's about 100 basis points. So the cost of capital, even for the government, is going to go up. They're going to have to continue to deploy as we get through this, and easily could be, you know, until June or July that we're still seeing additional stimulus. And so I think they're going to have to hedge their bet. So you're going to have to see some increases in taxes, just so you're not so far behind the curve that the government itself is having a major effect on interest rates and stifling the economy in the future. So these policies are, you know, pretty well going to be a foregone conclusion.
Now, right now, the other kind of way through this, and this is where the Bitcoin and the gold folks like to talk about inflation, devaluing that dollar as a way to kind of get through some of these complications. The inflation expectations are climbing. You point out that the University of Michigan, the latest survey shows that those expectations are rising. We've seen this before, and it's now ticking up again. So the concerns generally have been misplaced in the past, but there really hasn't been the level of concern that there is right now for quite some time. Dan, does this suggest that we should be preparing for higher bond yields if there is inflation, or is this telling us that our expectations might have run too quick already, given that we haven't had any big surge in inflationary metrics yet?
Well, I think we're going to see both. I mean, one's going to follow the other, and I think we're clearly going to see a tick up in inflation. And right now, most of the consensus is that we'll go back to, year over year, we'll go back to about a 3% run rate. And again, I think that's very, very probable if for no other reason you're coming off of such a low base. I mean, it just doesn't, with the economy basically having been shut down, prices across the board having been deflated for all capital items, all consumer items, except for, basic, consumer staples. You're going to have to see an increase, and you're going to see some increase in prices off of these very, very low bases. And when you come off of a low base, it doesn't take much, to get a 3 or 3.5% increase. And you're also, the same really applies to interest rates. I mean, it doesn't take much to really get you off of 0 to 25 on a Fed funds, or even where we were before, as I mentioned, at a 10-year Treasury at historic lows in the 0.6 level. So I think we're definitely going to go up. It doesn't mean we're going back to historically high levels from what we have, seen for some of us that have been doing this for a while, back in the 80s, for example. But we're clearly going to go up from where we are at this extraordinarily low level.
I want to talk about this connection to the market, where if we do get some inflation rise, yield rise, it should be good, in particular for the banks. I know you like LINC as one of the financial plays. It's also a big holding in some of the value funds out there. I see it crop up a lot as a way to kind of get exposure to yield curve expansion. What we just saw from the earnings, though, was a lot of the love was coming to the Wall Street banks as opposed to these regional firms. I'm curious, Dan, what the trade-off is there, being invested in a regional bank that might be more tied to interest rates versus some of these big banks like Goldman and Morgan that were able to generate some pretty massive trading revenue in this environment.
Well, I think they're both going to be positive, and actually, we actually have holdings in both areas. I mean, certainly the bigger banks, they're going to benefit from the reopening trade. They've benefited mainly from their own trading profits so far versus economic activity. But now they're going to be able to parlay on that, in essence, with the additional loan demand, interest rates going up a little bit will increase their net interest margins. So they're certainly in an area where they're going to be operating on all cylinders, and they're paying a very high yield for a lot of the banks, while you wait, that's only getting taxed at 20%. So we like the sector. I think Lincoln is a little bit of a different play. I mean, largely what they're doing, and most of their business is really coming from annuities. So they are heavily dependent on the market, but the market's been doing well. And so they're going to go well. And I think it's a good valuation play. They're only trading at 6x. They normally trade at 8 to 10 PEs. And yet you've got good, strong earnings that are going forward. And again, you get a good 3.25% dividend while you wait. So it's a little bit of a different play than the big banks. So we actually own both and think that both are going to benefit, Lincoln being one.
Okay. Dan, really great conversation. I like the connection back to the company specifics here. And looking forward to continuing this. We got a run closing bell coming up. Thanks for being with us, Dan.
My pleasure.
Appreciate it, Dan. Genter is the CEO and Chief Investment Officer at RNC Genter Capital Management.